to the curve to give you that information to start with. It's very easy to do. It's called the 2's, 5's predictor. So coming into the news, we simply take a look and we try and assess what the big boys think the news is going to be doing. These guys need to be positioned before the news. Why? Because if they can't get positioned after the news, because the trade will be gone. They can't chase a spread when there's a news event on, because there's no liquidity to chase the spread. So they've got to be in beforehand. So when I look at what they're positioning for this trade here, you could obviously zoom out on the big picture on a macro scale, but that's not the trade. The trade is, what are they doing coming into this news release? Now, there's a macro picture here that tells us that they're probably buying some bottom edge bonds, but we're nowhere near a bottom edge, so that's interesting. So we can be aware of that, and we can start getting into the short-term charts now. As we zoom into the short-term charts, one of the things that you start recognizing is that for the last 2 hours, the 2's, 5's is predominantly trading at a discount to the 5's, 10's. In other words, we're expecting what? We're expecting a rise in US yields. That's what the curve is telling us at this point. We're expecting a rise in US yields. Now, obviously, it becomes very, very interesting that when we get this switch around here, right into the news itself, that's exactly what's setting up. Buying the 2's, 10's means selling the bond price. Selling the bond price means higher rates. Higher rates means a drop in gold. Higher rates means a drop in the euro. Higher rates means a drop in the pound dollar. So we're already aware of the various markets that we absolutely can trade coming into the news release before the news release kicks off. That would probably mean sell-side equities in most cases. In most normal circumstance, and obviously there's a lot to be said that there's not a lot of normal circumstance coming in, but what equity market would you want to be short in, guys? The NASDAQ, right? The NASDAQ would make the best short. Why? Because the NASDAQ's going to respond really badly to our pop in interest rates, right? So if we're going to be selling equities, the equity sell is going to be the Qs. 14,952 was the price I got, 14,950, and we got down to a low price of 920. So we made 70 points, $1,400 profit in 5 minutes. So anyway, so let's take a look at what happened. Obviously, the bond price came off the previous level that we've sold to several times already, and a good bit of an opportunity to get short bonds. And obviously, the sell on bonds, it's done okay. It's not brilliant, but I think we've got probably an afternoon's worth where we might still be able to work into it. The only challenge we've now seen is that the 5's have dropped through, and we've obviously now got this measure to the upside here. We're thinking to ourselves, you know what, let's book some of our lovelies. Let's book some of that cash, and let's wait to see if we can find out exactly what these guys think of that data release. The NASDAQ was a big sell. If we're going to get higher interest rates based on the curve, we'd also expect to be able to sell some pound and some euro dollar. So we start looking for the pound and the euro dollar going into the release. We start looking at which markets have been overpriced, which markets have been underpriced. And unfortunately, they've both already sold off. The euro was already selling, the pound was already selling, and you just simply never had a chance to get involved in those trades. So the trades that you did have chances on would have been, for example, the gold market. You know there's going to be a gold popper in this, right? You know almost straight away there's going to be a gold popper in this release. And obviously the gold popper in the release was actually quite fast and it's quite brutal. We went from that 35 down to 30s, and obviously you got a Baltic at the very, very, very bottom price, and it just flipped it completely around. And you can see why that happened. There's no selling came in. It was a spike in liquidity, and that was it. No selling. So that was interesting, wasn't it? The other market that had a sell-off was obviously the pound, and the same type of response we had on gold, we had on sterling. You can see all these Baltics came in at the low prices. This time there was selling coming in, so we're expecting that to carry on to the downside for at least a tester to see what happens at the bottom edges of sterling. As far as the euro is concerned, similar story again. We saw the same Baltic, and again we saw in the euro no selling, as the price came into this trade here. They're shouting it down. They're trying to lowball the price. And they did it. They got a good lowball price. The buyers came back in and says, okay, I'll take a piece of that if you don't mind. That's exactly what they did. If we look at how it's affected the carry, it has added a little bit of bearishness to the euro dollar. And we can understand that. We can see how it's added a little bit of bearishness. Is it massively bearish? Not as much as you might think, according to how, obviously, the flip we saw in the interest rate curve. But we can start to recognize how easy this is to spot the change. And obviously, when we're seeing that, we might start thinking about, you know, where's the half-back trade? Where's the opportunity to maybe get some liquidity? And obviously, on the spike there, we obviously know where the bracket trade is. We've just into and about that half-back trade area just now against that previous swing low. So that's where the trade is. But the only downside of that trade is the fact that we never got any sellers at lower prices. We never got any sellers at lower prices. And that's disappointing, isn't it? So when we see that, we start to think about other things that we could add into the various storylines. We start trying to understand a little bit about that. And yeah, when we go through the whole process, you can see that trading things like non-farm payrolls is simply about one thing and one thing only. What is the curve telling us is going to happen? And that's it. That's all it is. What is the curve telling us is going to happen? Why? Because the curve guys need to get tens of thousands, perhaps more than that, of positions into place as aggressively as they possibly can do. And that means it will be visible before the start of the trade. If we know it's going to be visible before the start of the trade, guys, we simply get ready to do business. It's as simple and, as I said, as easy as that as a process. Covered it many times. Hopefully you managed to get some business done. And if you did, I like it. This afternoon, I'm going to focus a little bit of time and attention on scalping. We're going to look at the basic setups of the best scalp trades. We already have had a chat and several trades on oil, for example. We talk about zooming in and zooming out of that crack spread skew. We talk about bonds as a scalp as well, possibly 1 minute, but we always want to try and get that bigger picture on the scalp as well. And scalping is very important that we do multiple time frame analysis. So we don't just stick a zoomed in chart on a 1 minute chart and that's us, we're set for the day. Oh no, we've always got to remember what the macro tells us we should be trying to do. If it prefers the buy side, we should be preferring the buy side. If it prefers the sell side, we should be preferring the sell side. So we obviously add size to the sell or the buy, and we reduce the size on the opposite. We'll cover that in classroom. We'll cover that this afternoon through the US session.